So just to set the context for the next half hour, let me just briefly take you through what we're going to discuss. So this month's report is sectioned into three categories, which focuses on the first is the unsettling calm. So for the past quite a few editions, we've been talking about the euphoria that has built up in the markets. Now, while it continues, we further highlight this through some more data points and charts and the spaces to hide in such times. The next is India's growth drivers. Now, this particular section focuses on what has driven India's growth and how well these growth drivers can sustain India's growth going forward. The last section, which is early signals. So this basically focuses on the spaces to capitalize on in the coming period. I will let Sahil take you in detail through each of these sections. Over to you, Sahil.
Thank you and good evening to all of you. So today, as Pragati highlighted, we'll be discussing the September version of DSP Netra. The idea is to talk about the most important data and signals that we are gathering, and so that you can make good investing decisions. We come out with Netra on 5th of every month. So this is our 37th edition and 39th edition, and we would want to continue to come out 5th of every month with new and latest ideas. So, going through the September version, we'll talk about, as Pragati highlighted, three critical aspects. First, we will talk about the unsettling calm and the transition of market capitalization, how market capitalization is changing. So that will be the first section. So you look at the first chart on your screen, it talks about equity dilution. The idea is that when you go to the market today, there is a lot of discussions about who is the buyer. Largely, people are focused and talking about huge amount of SIPs coming into the market, where a lot of participants through the SIP route are putting in money into the market. There is a lot of direct stock buying, a lot of buying from DIs, which are domestic institutions other than mutual funds, and patchy but still present is the FI buying. So a lot of talk about the buyers, but very few people are talking about who's selling, because each transaction needs a buyer and the seller, and prices move in the direction of whosoever is more aggressive. So if the buyer is more aggressive, prices move higher. If sellers are more aggressive, prices move lower. At this point in time, buyers have been more aggressive and prices have shot up higher. But at the same time, what we are witnessing is a lot of companies are diluting their equity, which means that promoters who run these companies or own these companies, they are diluting their equity shares. They are selling out and selling to whosoever investor is interested in buying. So if you look at these two lines on the chart, the red line is the past 1 year return of the small cap index, and the black line, it shows you what percentage of small and mid cap companies have reduced their promoter stake, which means that how much equity dilution is happening in the market right now. So as you can see that the current ratio is now approaching levels that we saw 2 decades ago in the go-go market of 2003 to 2007. This ratio was higher, almost 30%. And now this ratio is reaching 25%, right? So we are witnessing levels that we haven't seen for almost 2 decades. And the reason could be that promoters find it lucrative to sell their equity at these levels, at these valuations, rather than buying them. And this tells you that there is some amount of uh, valuation discomfort probably building up in the market. And this is one way of expressing it. Also, if you look at various other data points, over time, you will see that a lot of equity dilution in absolute terms, which is in rupee terms, have also gone up significantly. So in FY24 and FY25 YTD, almost 4 lakh crores of equity dilution has happened through various sources. And this is a large number compared to the 2003 to 7 cycle. This could be one of the largest numbers for any 18-month period that we've seen on a rolling basis. So first slide conclusion, a lot of promoter selling is happening. A lot of buying, which is there in the market today, is being offset by a larger amount of promoter selling, which possibly tells you that people who run these companies are probably more comfortable selling their shares today rather than buying them. And investors should pay a close attention to the valuations that they are paying for the businesses. The second slide talks about the unsettling calm in a different manner. This is a slide partially we have shown in some other previous versions of DSP Netra. And what this slide tells you is that when you look at the Nifty 50 total return index, it is sort of making records in every time frame. So the first chart tells you that in the month of end August and September beginning, there were 14 positive closes, consecutive 14 days of positive closes for Nifty Total Return Index. The previous record was in 2007, which was 11 days of positive consecutive closes. And these records are on its own meaningless, but it highlights to you how much calm the market is or how confident participants are that the markets are going to keep moving upwards. Second record that you can see now, it is 53 months, and we've highlighted this record once it was made for 49 months. So this is the fourth such month that we are highlighting it, that now we have 53 consecutive months of Nifty move without a 5% month-on-month decline. Again, a rarity. There are no other indices in the world other than Nasdaq which could have done a similar feat. You also have now 6 quarters of 2% or more increase in Nifty index. And there is one more record that I have not highlighted here, which is that there are no 2 consecutive quarters of negative returns for Nifty since 2015, another 8-year record on a quarterly basis, apart from the record that I have put it on the slide. And the last one is that 13 years have passed that the index has not fallen 10% on any calendar year, which means that if you were patient enough, for 13 straight years, markets have not seen a large enough drawdown to give you returns worse than bonds, which is again one of the rare feats. The only other market to have done so is S&P 500, which created a 15-year rally without a 10% decline, which ended in 2022. And 1979 to 1999, 22-year record for S&P 500 without a 10% decline. Other than these three records, which is two for S&P and one for Nifty 50 Total Return Index, there is no other index which has done a similar record globally. So the unsettling calm more or less tells you that the records that we are making today are very rare, and it tells you one very important conclusion, that these kind of records will probably push people to take more risk because it hides the fragility or the inherent volatility of the market, and it more or less makes people unprepared for volatile turn of events. And that we think is a larger risk that has emanated from the market from these events. The next slide talks about the top 10 stocks. Again, one of the indicators which tells you that how fractured the market is. Although very strong breadth of the market, which means large number of stocks doing very, very well, is a great sign. It is a sign of a bull market, and that is what has happened. But more recently, what has happened is that the top 10 stocks, which are possibly the most profitable, almost counting for 50% or more profits of Nifty 50, almost 25% of free cash flow of all listed companies in India, their performance against the broader market, which is the NSE 500 or Nifty 500, has hit levels that we saw almost a decade ago. Okay, their underperformance has been so stark that it has washed away the outperformance of almost one decade. And as you can see that on a rolling 12-month basis, which means that the alpha that a Nifty top 10 index, top 10 equal weight index generates versus the NSE 500 is now at the lowest level that we have ever seen. Okay. And this is one indicator which tells you that the top 10 equal weight stocks are at one of the worst places that they could be in terms of underperformance, and therefore a mean reversion is quite likely. Last time we saw such reading was close to the 2008 top in the stock market. And although the divergence took almost 6 months earlier, and then it bottomed and started to go up, which means that the top 10 stocks started to outperform even before the market had peaked out. And possibly we are seeing very similar dynamics play out today. Although it's not a sure signal that it will always happen like that, but the similarities are very, very clear, both in terms of price dynamics and also in terms of how valuations stack up for top 10 companies or for the rest of the universe. And therefore, we believe that if there is a new single rupee, which is earmarked for equity today, although initial view is that if you are putting money as in your portfolio, if you are deploying more money in your portfolio today, it should first go to, let's say, a multi-asset strategy or a category of hybrids like an ESF, etc. But if there is an equity money, we believe that the top 10 category or the large cap category should be your first order of call, first port of call where the money should flow. And because the relative price and relative valuations are much more attractive for the top 10 stocks. The next slide talks about a big divergence which has happened in Indian markets versus in US markets. And why we took these two markets? Because these two are the only markets which have rallied sustainably over this 20-year period, while rest of the markets have been more volatile. And as you can see that there are many instances where these two lines, that blue and black line, has diverged. What are these two black and blue lines? First, the black line is the BSE small cap index versus the Sensex, which means that when the black line is going up, small cap stocks are outperforming large caps. When the black line is falling, Indian small caps are underperforming large caps. And similarly for the US market, S&P 600 small cap versus S&P 500. So when the blue line is falling, which means that the small caps are underperforming. So as you can see, in the last 1.5 years, Indian small caps have outperformed the large caps significantly, while in US, the small caps have underperformed significantly. And you can see that there is a large crocodile type mouth which has opened up here, a huge divergence. Last time we saw a similar divergence was in December 2007, where Indian small caps are outperforming while US small caps are underperforming. And we've seen similar outcomes earlier, but on the opposite side, where Indian small caps are underperforming and US small caps are outperforming. So these cycles, come and repeat themselves again and again. What is the key takeaway? We think that the broader markets in India, which is X of large caps, have become more pricey. They have rallied in spite of small cap not rallying globally, which means that there is a large divergence which has happened domestically. And in US, we believe that this trade is now unruffling, where larger companies have begun to underperform. And in India, again, we think that this trade is sort of reversing, where smaller companies are beginning to underperform large cap companies. So once again, these are some indications which are available to us in real time, although they are very hard to believe when they happen in real time. In hindsight, they are very easy to spot because you can easily make these charts and say that XYZ happened in December 2007 or so. But in real time, even if you had spotted it in August 2007, by the time you reach December 2007, your patience would have run out. And that is what happens in real time. So although we have no idea when these ratios will peak or which month they will peak, we have no clue, no idea, or no forecastable ability. But as you can see, when extremes are reached, you don't need to know when will they turn, right? Only knowing that we are at an extremity is enough to take precautionary measures and possibly take measures which will be ideal for your portfolio. The next slide is one of my favorites, and it talks about why bad times are the best times to buy small and mid cap stocks. So currently we are not in bad times, we are in good times. And how do I define good times for small and mid cap? So we started, you see the three lines in the upper panel. The black line is for large cap index, the blue line is mid cap index, and the red line is small cap index. And we have started with a base of 100, normalized all three category of indices beginning 7th April 2003. And as you can see that as the market proceeds and the bull market unfolds, small cap and mid cap have outperformed large caps by a very wide margin. By the time they reach the peak of January 2008, small cap index and mid cap index have created alpha of more than 13 and 25% over large caps, of very, very large outperformance that they created. But as soon as the market turned, when it fell, the small cap and mid caps lost all the alpha that it had accumulated over a 4 or 5 year period. And when the next bull market unfolded, once again, small and mid cap stocks outperformed, as you can see. Okay. And then again, a bear market came in, small and mid cap lost all alpha over large caps. And similarly, in the next two cycles, in the current cycle, we are sitting at a very large alpha for small and mid caps. You can see that over almost a 21-year period, mid cap and small cap are sitting on 4% and 5% cumulative CAGR alpha, which is a very large number because it delivers extraordinary returns. And our contention is that when you look at the lower panel, you will see that there is a rolling correlation. That means on a rolling 2 year basis, the small and mid cap, whenever their rolling alpha hits 20% plus, peaks are close to 22% or so, or 24% or so, usually you see a period where small and mid caps underperform. Okay, and possibly we are seeing that rollover of this outperformance. Right? That means that the outperformance of small and mid cap over large caps has begun to roll over or begin to reduce. And this is the first signal that market is probably signaling that there is a period of risk off which is building up, and which once again tells you that it is more prudent to, you know, tilt your exposure more towards large caps or possibly take precautionary measures to go and hide in hybrids. And this is again one very important learning that over a very long period of time, if you were able to invest in small and mid cap when they did not have alpha over large caps, okay, when their alpha was missing, when things were bad, which means the bad times, those were the best times to buy small and mid cap stocks, not when they have very large alpha like the times we are in right now. So one conclusion is very clear that the time to add aggressively to small and mid cap stocks is not today. It will probably come whenever it comes. But today, the extremities are tilted and they favor large caps versus the small and mid cap stocks. So the last slide in this section is one more indication which comes from factor investing. So a quality factor which has underperformed the market, largely high quality stocks which have good balance sheets, low variability of earnings, steady growth. These companies have underperformed the market. The reason is that other companies which are more cyclical in nature, whose profits were depressed and who are coming out of a cycle, they outperformed, or the momentum factor outperformed the market by a very wide margin. But if you notice very carefully, in April and May, in large caps, in mid caps, and in small caps, the quality factor made a return. Okay. So when the election results came out, or a period around that before and after election, you will see that, you would know that the market fell almost 8.5% from the peak, and then it rallied back and made new lifetime highs. But this new lifetime high, which was formed after that crack, did not come with the performance of the stocks which were leading before that event took place. Okay. So the post facto, or the stocks which have rallied after the event, are very different. These stocks come from the quality bucket, not from the momentum bucket so much. In fact, the leadership has also changed in terms of who is outperforming. And that tells you that market possibly went through a pivot. And we have seen this pivot happen even in the past, where prior to a cyclical top in the market, you will see leadership change, factors change, and a lot of churn happen within the sectors. And this possibly is one more sign that tells you that it makes a lot more difference to tilt your portfolios towards quality, factors rather than going for momentum factor. That this again is an indication coming from the market. How right or wrong it is, we will come to know, and we will want to cover it in the future editions of DSP Netra. But this is again one more reading which the market is throwing up, and we are here to take note. So this was the first section which talks largely about two things: to focus more on large cap versus small and mid caps at this point in time, and also tilt your focus more towards quality factor than anything else. The second is the drivers of India's economic growth. And as you know that post-COVID, the government of India spent a huge amount of money. It did large expenditure, largely on capex, largely spending on infrastructure and fixed assets, which turned out to be very, very good. It helped the economy recover very, very smoothly, and it did well from that period onwards, and did much better than most other countries did in the same period. And as you can see the panel here, the downward orange bars which are in the red is the fiscal deficit of Government of India. As you can see, we are running 5.5% fiscal deficit. Just imagine that we ran similar numbers way back in FY 85, 1985 to 1990, right? And that is how long ago we spent this kind of money from government budget. And it has resulted in large growth phase for the Indian economy. Now, two questions arise. Can we run 5 to 6% deficit perpetually? The answer is no. And the reason is that if other countries like United States and ECB and Eurozone government and UK government, others, because they are also running very high fiscal deficit, if they plan to pull back, if they stop doing the fiscal deficit they are doing today, we will also have to stop. We'll also have to reverse. We'll have to go back to 3.5% fiscal deficit. And that will take away this advantage of extra expenditure that we are seeing today. So the fiscal expenditure that we've seen is already being rolled back, and that will possibly have some smoothing impact or some calming impact on growth. It will bring down growth. In fact, as we speak today, corporate India is deleveraging, not taking a lot of loans. Government of India is now also deleveraging, which means it is trying to reduce its debt. So two very large entities, which is the government and the private corporate, both are deleveraging. So the only sector which is trying to leverage is the household sector. Okay. And so the key takeaway from this slide is that Government of India, which has been the biggest driver of capex of growth over the last 3 to 4 years, is now stepping back. It is trying to consolidate, and we will only know in the future whether this is the best decision or good decision or bad decision. But as of now, these are the numbers which are coming in, and they will probably have a drag on growth. Second, as I said, there are only three entities in the economy. One is the government, the other is the households, people, average citizens who are spending, and third is the private corporate. Only these three entities. So we'll talk about them. First entity I spoke about, Government of India, which is borrowing and spending money, and now reducing its borrowing. So it will have to reduce its spending. Second is the India's consumption. And as you can see that this black line shows you the 5-year CAGR of India's private final consumption expenditure. Okay. This is in per capita, which are denoted by these bars, which means that on a per capita, per person basis, India spends almost 1,27,760 rupees per capita. This is in rupee terms, right? And when you look at the growth rate on a 5-year CAGR basis, for example, in FY13, the growth rate peaked at 13.8% on a 5-year CAGR basis. Prior to that, when global financial hit, it had fallen to 6%. So on an average, our growth rates have been upwards of 9 to 10%. Currently, post-COVID rebound, even our rebound has gone to 8.5%. In fact, in the last quarterly GDP number, this number came in at around 7.6%. And in most, financial reporting outlet, it was denoted as a strong number because it had recovered. So now you can see that even our current strong numbers are weaker than our long-term average growth rates, which means that the consumption growth trends in Indian economy has slowed down. And why am I highlighting this fact? The reason is that consumption is 60% of India's economy. A lot of us believe that capex cycle is enough to drive India's growth, but it has its own limitations, because when you look at the size of India's economy, the largest component which contributes to growth comes from consumption. And consumption growth, as you know, is in the slow lane, depicted by FMCG companies and other companies, which are highlighting that their volume growth is in low single digits. And similarly, those same trends are appearing in GDP numbers also, which we think could be a source of risk for our next slide, which is the capex cycle. So you can look at the last 3-4 years as a very, very strong and positive development, where Government of India spent a lot of money and kick-started what we call the capex cycle. But when you look at the upper panel, it will show you a bar graph. This bar graph has three colors. The upper color, which is the light orange color, it is the overall investment or GFCF of the household sector. So as you can see that out of 100 rupees, households contribute almost 41 rupees to India's investments or gross fixed capital formation. The private sector, as you can see, contributes another 33 to 35%. Only these two entities, which is the households and private corporations, account for more than 3/4 of all fixed capital formation, gross fixed capital formation, or what we call capex or fixed asset creation. The Government of India contributes between 10 to 15%, sometimes 20% in various years. So its overall share, overall pie in GFCF is not very large. It is sizable, but not very large. That means that even if Government of India spends more and more, it can only have a limited impact. It really needs the private sector to step up. It needs the households to spend on infrastructure, on creation of houses, which is what the households do, and private corporates to spend money on gross block addition to expand capacities. Unfortunately, that number is not coming, right? So, for example, in FY21, you can see the households and private corporations delevered, which means that they actually reduced their fixed capital formation. And in next 2 years, they rebounded. These are not absolute numbers, but incremental contribution by each one of them. As you can see, Government of India has tried its best to have a higher contribution by spending more money. Even then, our overall growth rate has been sliding down. What is the reason? So there could be two reasons. One, that the private corporate sector or the household sector is not ready to spend. Maybe it wants to deleverage. It is still afraid of the last cycle and it wants to have better balance sheets. Second could be that the private corporates do not see the visibility of strong enough consumption so that they put more capacities. Okay, so this is a very, very important point, and maybe you can recollect it and reread it and read about it more. That unless businesses see strong, robust consumption growth, they will find it very hard to put more capacities. And that is why slide number 1, 2, 3 in this section are all linked. They have a single flow of thought, which tells you that if government expenditure is going to slow down for whatever reason, because it is trying to deleverage, and household consumption is not very strong, it is just middling, private corporate capex will find it very hard to scale up. And therefore, the strong levers which has caused India's GDP growth to be at 8% plus or 7.5% plus will find it very challenging to stay there, which means that our growth rate overall can slip, it can come down. And these numbers are actually visible when you look at our core GDP numbers and other numbers, that they have already slowed down to some extent. The next is the third lever of growth. So, for example, if we have 100 rupees in the economy and households spend 70 rupees, they will save 30 rupees. With those 30 rupees of savings, the investments or fixed asset creation will be done, right? So, for example, if 30 rupees of saving causes 30 rupees of fixed asset of gross fixed capital formation, and that can cause a growth rate of 6-7% in the economy. And if you want to increase that growth rate, you want to take that growth rate, GDP growth rate from 7 to 8 or 8.5, you will have to increase your fixed asset creation or GFCF. Now, to do that, you cannot create more savings. So there are two ways to do it. One, either force households to consume less and save more, which is the Chinese model, or you can import savings, which means that either you run a balance of payment surplus or current account surplus where you sell more goods and get dollars inflow. That dollars becomes your domestic savings and are channelized for creating investments. Okay. Or the other way around, as I told you, reduce domestic consumption, increase investments, and therefore, over a longer period of time, your growth will improve. In both these instances, India is middling. It is not doing anything great, not choosing one model over the other. Overall, our model is dependent on domestic savings, largely because we run a fiscal deficit and we also run a balance of payment number in terms of current account deficit, right? So, one of the largest growth pillars that can unfold for India is exports. And when you look at the numbers over the last 10 years, you will see that our export growth has been only 3.3%, which is a very, very slow number. In fact, global growth have also been very slow. Global exports growth over the last 10 years has been very slow, which also tells you that India performs much better when the world is doing fine, which means that if world is growing at a good pace, India will outgrow the world. But if the world slows down, India also slows down, and which comes up in numbers. So a benign global environment is actually very beneficial for us, which has not been the case over the last 10 years. And as you can see that in case of exports, most of our export categories have not grown. For example, textiles and ready-made garments has given a CAGR of 10 basis points over a 10-year period. And similarly, the strongest number has come in electronics goods exports, which you can see has ramped up post-COVID, which is highlighted in the brown bars. As you can see that pre-COVID, it used to be 70, 79, 74, 72 billion, and now it has ramped up to 100 billion or so. And but this number also comes from re-exports, because as you can see that even electronic good imports have grown at 9.8%. So the incremental benefit has only been to the tune of 4% CAGR, which over a period of time will build up. But other than that number, we are not seeing any significant inroads being made in any export sector, which could bring in the dollars and improve the overall efficiency of our saving cycle. and get that wheel moving. So this is probably a missing opportunity or missed opportunity for now. If there are changes which occurs in India's trade basket, it will be beneficial for the whole economy. As of now, those changes are not apparent. So when you look at the domestic factors, which is the consumption cycle, or when you look at the investment cycle, which is gross fixed capital formation, or the third pillar, which is exports, all of them are possibly headed for the slow lane, and which should probably reduce our growth rates from a very strong number of 8% to possibly 6.5, 7, or even lower. The next is, how does the fiscal numbers stack up? So as I said, over the last 3 to 4 years, Government of India did a lot of expenditure. And so we thought that we should not just borrowing, we should also look at the tax collections. So when we had a look at the tax collection numbers, you can see that over FY19 to FY25, the full 6 year cycle, our nominal GDP has grown at 9.5%. And this also has the impact of COVID, so the numbers look a little smaller. But as you can see, apart from income tax and customs duty, which I will explain now, no other tax has grown at more than nominal GDP growth rate, which means that the tax buoyancy has been missing. GST is only 10.6%, not a significantly high number when you talk about tax buoyancy, but income tax growth has been very strong. And similarly, custom duty, which largely took a lot of benefit from Russia-Ukraine war, where a lot of new taxes were introduced, both in terms of some excise duty and custom duty. We got some benefit there. But in terms of overall income tax growth, two things come to mind. First is, why did income tax outgrow nominal GDP by almost 600 basis points? Did more people start paying taxes? Roughly, the growth rate has been very similar like it was in the past. Were salaries and wages growing at a very fast clip? Partly, yes, they were growing at 14%. So it partially tells you that income tax growth would be higher. But there is still a 300 basis points alpha to be explained. And to our understanding, that alpha has come from capital gains. So the table on the chart on the right tells you that the increase in market capitalization is directly reflected in high income tax growth for Government of India. And so what does it tell you? That this is a very unique cycle. India domestically, the stock market has little or weak correlations with the economy, unlike Western countries like the United States, where the stock market is the economy and the economy is the stock market. They are very, very closely linked. In fact, so closely linked that the stock market cycle can dictate consumption trends in United States. But that is not the case in India. In India, the stock market has been quite different because participation has been very patchy. But this is the first cycle where you are seeing government revenues being influenced significantly, which is the tax revenue, by growth rate in the stock market capitalization, which we think is a new fragility being introduced in the system. The reason is that stock markets are inherently volatile. That is their nature. They move up and down depending on the moods and sentiments of the investors. And if those sentiments dictate the tax correlation, it becomes an unsteady proposition. Because at the same time, when the government is trying to borrow less, if its own tax revenue becomes more volatile, it will have to pull back more on expenditure than it would have otherwise. So in this section, we spoke about three very crucial aspects: that India's growth, which was situated on the pillar of strong government expenditure, is possibly now very closely linked to how markets perform, which introduces a new fragility. Second, consumption, which is the backbone of India's economy, 60%, is possibly slowing down. It's in the slow lane. Third, Capex cycle, which has got a good tailwind from government expenditure, is possibly facing new headwinds because businesses are not putting in new capacities at the rate that they should, and the government's own expenditure is actually slowing down. So, in totality, all the three drivers, out of which one was very, very strong, which is government expenditure, and the other three, which was middling, are now seeing a drag and possibly will drag growth slower. The last section is on early signals and has only two segments. One is gold miners, and gold miners are a bunch which are available in global markets only. There are hardly any gold mining. There are two gold mining companies in India, but they don't mine gold. They don't have any mining operations as of now, active mining operations. So these are only global international companies. And as you can see, we have highlighted a number of companies here. And we've also highlighted what is their 10-year low valuation based on EV to EBITDA, what is the 10-year high valuation, and what is the 10-year average and where they are trading right now. So two or three very large companies like Barrick, Newmont, uh, Agnico Eagle, etc., are available to you at below average valuations, which is a rarity in today's market globally, that you find any sector trading below its long-term average valuation. And these 10-year average valuation themselves are of one of the lowest or the worst cycle in gold mining sector. And this tells you that there is a large margin of safety which has crept up in this sector. Second, recently gold prices moved up. They showed a rally of 20-25%, and that has started to come and show up in the numbers for gold mining companies. Their sales numbers have started to improve, EBITDA has started to improve, margins have started to improve, gross margins have started to improve. So this tells you that the positive rub-off because of gold prices has started to show up in this sector, and possibly as soon as we reach September results, we'll be able to see more clearly what are the effects of higher gold prices on this sector. Our conjecture is that if gold prices continue to move higher or continue to trade above 2500, 2550, these companies will report solid numbers and possibly attract a lot of re-rating. The next slide is the last slide, which is from the BFSI sector. As you can see that over time, BFSI sector has been one of the stark underperformers. The lower panel tells you that X of BFSI, the market trades at 28 times trailing multiple. When you look at the full market, it trades at 24 times. But when you look at only BFSI, it trades at 17 times. So it's like the two divergent ends of a scissor, right? And the market trades at a premium valuation when you remove BFSI, and BFSI alone trades at a much lower valuation, while the PAT growth for the sector is one of the highest compared to all other sectors, which tells you that inherently this sector has a lot more margin of safety to offer versus the rest of the market, and therefore we continue to remain overweight in spite of all the headwinds that the sector is facing. We feel that the margin of safety is much higher when you compare it to all other sectors. So this last slide is to avoid confirmation bias. This is a behavioral slide that we put at the end, and we believe that there is a lot of evidence out there. If we just accept it at face value and then look at it and dig deeper, or what are the trends that it highlights, it could bring us a lot of benefits. So this brings me to the end of the whole presentation, and I hope that all of us can gather together next month and talk about DSP Netra once more. So with this, I would like to thank all of you for attending this webinar, and we'll come to you with a fresh report in the month of October once again, and we'll release it on 5th of October.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.